right, so as we projected, the Fed did not hike rates last month or in June. Last week. That is kind of the general consensus. We sort of knew that he was going to pause, but he did, as we projected also, forecast that there are probably 1 to 2 more rate hikes in the future. That being said, we have no idea what he's going to end up actually doing, but there is definitely a chance there that prime could be going up to 8.5 or even 8.75 by the end of the year. Now, he also said prepare for rates to be increased for a longer period of time. That is remains to be seen, because think about it. Back when he first started raising rates, the forecast was a lot lower than what he was planning on, and then he proceeded to raise rates 10 times consecutively. So that's the longest or the fastest increase in history. So you just don't know. And so the data has been a little bit stubborn, obviously, because of everything that we've been dealing with the pandemic and everything. So what does the data say? Well, we did anticipate that CPI was going to come back at around 4.1 last week, and it came in at 4%, which is really good news. And then PPI was forecasted to come in at 1.5%. It came in at 1.1%, which is also good news, meaning that the economy is slowing down, and it is showing in the numbers, and it's moving quite significantly now, because we have surpassed that peak of last summer, basically, where we had the highest inflation readings. So those are falling off of the 12-month average, which is causing our numbers to actually make meaningful drops now. So anyways, that is really good news. We will see what ends up happening with the Fed funds rate. But what does that mean for treasuries? So last week, treasuries were obviously a bit elevated. That tends to happen right around the time that the Fed speaks, that rates will spike a bit and then they'll kind of go flat. But after that, since then, basically the 10-year treasury has dropped 11 basis points. The 5-year treasury has dropped 12. So hopefully we should start to see some more drops in treasuries here soon, which should amount to some lower rates, which would be really good, because honestly, the market is super driven by interest rates right now, right? So a lot of deals, it's tough to make them make sense, especially in the multifamily space. At least here in San Diego, cap rates are really, really low still. And so it's just not making a lot of sense for deals. People are underwriting a lot of deals. They're trying to make deals happen. Of course, they're out there. I've seen a couple of home runs happen lately with some of our clients, but it's been few and far between, especially for people who were typically very active. So I think we're all trying to make sense of this market now, and we're starting to get a little antsy looking for deals, feeling like we should be doing something, especially when the market is slow. It just feels odd. But I am seeing some people try to make deals happen. We are certainly trying to make them happen too. I've got rates in the high 5s now, which is really good news for all of us. That helps, right? So if we can get those rates down to like that 5% range, obviously things would start to move again, but then we'd be dealing with a lot of competition, right? So we're seeing a lot of competition already on the residential side. People are losing bids. They're getting in bidding wars again. Things are going over list just because of a lack of inventory. So I looked last week, and out of the whole San Diego County, which included some areas which I wasn't even sure were San Diego County, like Boulevard, California, for example, there were 85 3 to 4 unit listings on the market total. Okay. We're used to seeing at least 150, if not more. So that just goes to show you that inventory is maybe, if we're lucky, 50% of what it should be. And apartments are still low as well, but I'm seeing these cap rates. I looked at a deal yesterday that had a 1 cap. So obviously it's a beach property, but I'm also seeing other cap rates in the 3 and 4% range. But when rates are close to 6, obviously there's a gap there. Now, a lot of people are saying, yes, it's true. Once rates drop, that you'll get that pop in cash flow. But do we recommend buying a property based on the fact that we think rates are going to go down? That is up to you, and that is up to your risk tolerance. So it's really up to you to kind of make that decision. I generally hesitate to make decisions based on future assumptions. That being said, I would do your kind of like best and worst case scenarios when you're doing your underwriting. That's how I've been doing it for a lot of our clients, to say, okay, so your best case scenario is, rates drop to 5, and this is going to be your cash flow if you can refinance within the next few years. Worst case, maybe they drop to 5.5, or like next kind of middle case would be maybe that they drop to 5.5. And then absolute worst case would be that they drop to, that they stay at 6, let's say, where you can get financing now. So that would be the way that I would run your scenario. And if you can live with some sort of a blend of that, then maybe make the offer. So it's sort of up to you, but people are looking at other opportunities, other income opportunities, because right now, just like straight vanilla multifamily is not making a ton of sense. So I see a lot of people that are now transitioning maybe to triple net, especially if you're in a later season of life and you just don't want to deal with all of the new laws and all the crazy things that are coming out. But then I'm also seeing, people going into boutique hotels, also industrial still very strong. Rents are going up in that sector. So we are seeing some people diversify just to try and find deals and actually just kind of stay in the game and keep their money working for them. So those opportunities are out there. If you have any questions and you're wondering what you can do financing wise, please do reach out. Like I said, and I keep saying every week because it is so true, there's a lot of lenders coming in and out of the market. So for example, I just got an email last week that one of our lenders came back in the market recently. So that's been really good for us in terms of getting some more deals done. They had more competitive rates. They were more aggressive on their underwriting. So I have lenders that are coming in and out of the market. Seems like daily, weekly, but it's just happening at a rapid pace and there's a lot of volatility in the market. So it's best to just check and recheck your numbers, especially if you've been negotiating a deal for a few weeks. Things could have changed drastically by the time you actually seal the deal, and you want to just make sure that your underwriting still works. So have a fabulous week, everyone, and I will see you next week.